$1.7 trillion disappeared in 90 minutes. Not from a war, not from an earthquake, not from a bank run you could see on the street. It vanished on trading screens, inside the paper plumbing of the precious metals market. And if you think that's just volatility, I want you to sit with the scale of it. That number is larger than the entire annual output of countries like Spain, gone in the time it takes to make coffee and pretend markets are rational. This morning, gold was trading around $5,100. Silver printed an all-time high near $117 or $75. Then the trapdoor opened. Within about an hour and a half, gold slid roughly 2% to around $5,000. Silver didn't dip. Silver got hit with a 12% air pocket, falling from roughly $117 to roughly $103 before bouncing. And if you're staring at that and thinking, is this the start of something uglier? You're asking the right question, because the important story isn't that the price fell. The important story is why silver fell 6 times harder than gold, in the same minute, in the same complex, with the same macro backdrop. Stay with me, because in a few minutes, I'm going to walk you through the single most important chart feature most people never learn to see. A multi-decade level that has been quietly dictating silver's biggest turning points for 30 years. And after that, we're going to talk about the real accelerant today, a mechanical rule change that forces selling whether you want to sell or not. That's where this gets dark, because it exposes how much of price discovery is actually just leverage getting squeezed. Now, welcome back to the Dollar Watch. If this breakdown helps you understand what just happened and what could happen next, hit like and subscribe. Not because of ego, because YouTube only pushes serious macro analysis if the audience signals it wants serious macro analysis. Here's the hard reality. Gold and silver trade in the same neighborhood, but they live in different houses. Gold is primarily a monetary metal. It's held as reserves, hoarded as collateral, bought as a hedge against sovereign incompetence. Silver is that, plus something else. It's an industrial input. It has a split personality. And that split personality is exactly why silver's rallies are more explosive, and why silver's crashes are more violent. So what happened today, in plain English? 2 triggers hit at the same time. The first was technical. Silver ran into a multi-decade resistance level, an area where sellers historically show up with size, where algorithms are literally programmed to react. The second was structural. The COMEX futures market got tighter overnight because the exchange raised margin requirements. That is not a headline detail. That is the match that lights forced liquidation. And there's an open loop I want to plant right now, because it will change how you see the entire move. While paper silver was collapsing, physical silver premiums in the real world didn't collapse with it. In some places, they rose. That divergence is not a fun fact. It's a stress fracture in the market. We'll come back to that, because it's where the $1.7 trillion vanished story turns into a $1.7 trillion transferred story. Let's start with the thing most people misunderstand: why a margin hike can cause a crash even if nothing fundamental changed. The majority of headline trading in gold and silver does not happen because someone took delivery of bars. It happens through futures contracts, paper agreements to buy or sell metal at a later date. Futures are powerful because they're leveraged. That means you can control a large position with a relatively small amount of cash posted as collateral. Here's the simplest version. One standard silver futures contract is 5,000 ounces. If silver is $100 per ounce, that contract represents $500,000 of notional exposure. But you don't post $500,000. You post margin, maybe $20,000, maybe $22,000, depending on volatility and exchange policy. That's the down payment. That's the collateral that says, I can cover losses as the price moves. Now imagine the exchange changes the rules. Suddenly, that same contract requires $32,500 instead of $22,000. That's not a theory. This is the type of increase we're talking about. If you're a leveraged trader, you have exactly 2 choices: wire in more cash immediately or reduce your position by selling. Most traders do not have spare cash sitting around waiting for a margin surprise. so they sell. And when thousands of leveraged traders are forced to sell at the same time, you don't get an orderly pullback, you get a liquidation cascade. Selling pushes the price down. The price down triggers more margin calls. Those calls force more selling. Liquidity vanishes exactly when everyone needs it. That's when you see a 12% move in 90 minutes, and people call it manipulation, because psychologically it doesn't feel organic. Mechanically, it's perfectly organic. It's just ugly. Now put a pin in that, because margin hikes explain how the decline accelerates. They do not fully explain why silver fell so much harder than gold right at that moment. For that, we need to talk about the chart level silver just hit, because this is where the move becomes predictable. Most people look at charts like they're weather maps. They see squiggles, they guess. Professionals don't guess. They map zones of compelled behavior, areas where institutional order flow historically changes. The two core concepts are support and resistance. Support is a level where buyers reliably step in. Price falls, hits that zone, demand shows up, and price bounces. Resistance is the mirror image. Price rises, hits a zone where sellers reliably step in, supply overwhelms demand, and price gets rejected. Here's the mental model. Think of price like a ball. Floors are support, ceilings are resistance. When a ball hits a floor, it rebounds. When it smashes into a ceiling, it snaps downward. Markets do the same thing, except the ball is leverage and human emotion. Now, over roughly 3 decades, silver has respected a specific long-term level that has acted like a hinge in the market. In the late 1990s through the mid-2010s, silver traded inside a descending channel. Lower highs, lower lows, a long grind that trained people to believe silver always disappoints. Inside that channel, there was a midline, call it the white line, that marked major inflection points. In 2008, during the global financial crisis, silver collapsed to around $8 and tagged that long-term line. And what happened next wasn't a normal bounce. It was a regime shift, from roughly $8 in late 2008 to around $45 by 2011. Silver rose approximately 462%, not because silver became magical, because the world was forced to confront what happens when central banks respond to a debt crisis with liquidity, bailouts, and monetary expansion. When confidence breaks, hard assets reprice. But here's the part most people miss, and it matters today. In 2008, silver hit that line from above on the way down. It behaved like a floor. In 2026, silver ran up into that same long-term line from below. The floor became the ceiling. Former support becomes resistance. That's not a slogan. It's a real phenomenon driven by positioning and memory. Traders who got trapped at that level in the past are waiting to sell when price returns. Meanwhile, new buyers hesitate because they see the same level as expensive. So when silver printed that all-time high near $117 and ran into multi-decade resistance, it wasn't just hitting a random number. It was hitting an institutional tripwire. And when you combine an institutional tripwire with a margin squeeze, you get a move that feels like it came out of nowhere, unless you know what to look for. Now here's the open loop. Does a violent rejection at multi-decade resistance mean the bull market is over? Or does it mean the market just purged leverage before the next leg higher? The answer determines whether today was a warning shot or an entry point. We'll weigh both cases, but first, you need the historical context that mainstream coverage almost never provides, because it's not about today. It's about the recurring mechanism. Silver has a habit of peaking into leverage and then getting regulated at the worst possible moment. If you've never heard of the Hunt brothers, you should, because their story is the blueprint for modern precious metals panics. In the late 1970s, Nelson and William Hunt accumulated enormous silver exposure, partly as a hedge against inflation and dollar debasement. Silver surged, famously reaching around $50 in 1980. And then the rules changed. Exchanges implemented restrictions, famously liquidation-only conditions, and aggressive margin changes that made it far harder to buy with leverage. The market broke. Silver fell brutally. The hunts were ruined. Fast forward to 2011. Silver had rallied from the 2008 lows into a new speculative frenzy, flirting with $50 again. And then the exchange raised margin requirements repeatedly in a compressed window, multiple hikes within days. Once again, leverage got flushed, price fell hard, and sentiment died for years. Now look at 2026. Silver runs from the 20s and 30s into triple digits. The exchange raises margins materially, and right as price meets a multi-decade technical ceiling, silver gets hit with a 12% flush in 90 minutes. Same playbook, different decade. And if that sentence makes you uncomfortable, good. Because it means you're starting to see the market as a system, not a price quote. Now let's separate what's emotional from what's factual. People will immediately default to one of two narratives. Narrative 1. This proves the silver bull market was a bubble. Narrative 2. This proves the market is rigged. Both narratives are seductive. Both can be partially true in the short run. Neither is a complete analysis. Let's do this like adults and run the evidence. The bearish case first. Silver was up roughly 270% in about 12 months. That is parabolic behavior. Parabolic moves create fragile structure. They attract late money. They pull in leverage, and they leave behind a market that can't absorb bad news or even rule changes without breaking. Second, the gold to silver ratio compressed aggressively. When that ratio moves too far, too fast, it often mean reverts, and the mean reversion frequently expresses itself through silver downside because silver is thinner and more speculative. Third, positioning matters. When everyone is on the same side of a trade, when social media is euphoric, when taxis and group chats are talking about silver, markets don't reward consensus, they punish it. Not because the asset is bad, but because the marginal buyer is exhausted. At that point, it doesn't take much to knock the market over. Fourth, and this is the most uncomfortable point, margin hikes have historically been associated with local tops, not always secular tops, but local tops. They are a signal that volatility has reached a level that threatens the exchange itself, because exchanges don't exist to make you money. They exist to manage counterparty risk. When they tighten, it means the plumbing is under stress. So yes, there is a coherent bearish argument that says today could be the beginning of a larger unwind. Now, the bullish case. And you need to listen carefully, because this is where the paper crash story collides with physical reality. The fundamental supply and demand picture did not improve for bears this morning. It didn't change at all. Industrial demand for silver is not a vibe. It's engineering. Solar panels require silver for conductive paste. Electrification requires silver in switches, connectors, and high-reliability components. EVs use more silver than internal combustion vehicles. Data centers and AI infrastructure scale electricity throughput, redundancy, and power conditioning. More silver. 5G buildouts expand the lattice of high-frequency electronics. More silver. You can debate the pace, but you cannot debate the direction. Silver is embedded in the electrification of the economy. On the supply side, silver is not like oil where you can flip a switch and flood the market. A large percentage of silver supply is byproduct production, meaning it comes out of the ground because companies are mining copper, lead, zinc, and gold. That makes silver supply inelastic. If silver price spikes, you don't instantly get silver OPEC bringing on new barrels. You get a slow, multi-year response, if any. New mines can take a decade between discovery, permitting, financing, and construction. And that's in a world that isn't politically hostile to mining, which increasingly it is. Then we have geopolitics. If a major producing nation restricts exports, or if a major consuming nation hoards inventory, the marginal availability in global markets can tighten fast. You can call it policy, you can call it economic warfare. But the result is the same. Less metal is available to meet industrial draw. Next, inventories. When people say there's plenty of silver, ask them one question. Where? Because in commodities, supply that isn't deliverable at the right location, at the right time, in the right form, is not supply. It's a spreadsheet comfort blanket. And now we get to the part that almost nobody on mainstream desks wants to touch, because it implicates the credibility of the paper pricing mechanism. In the physical market today, the premiums, the amount above spot price that real buyers pay for real metal, did not fall in lockstep with the paper crash. In some cases, premiums rose because retail and wholesale buyers treated the drop as a buying window. Dealers didn't say, "Sure, 12% off, come and get it." Many of them said, "Inventory is tight, demand is spiking, and we're not going to subsidize your panic." That matters because it exposes a basic truth. Futures markets can reprice quickly. Physical markets reprice slowly, and sometimes not at all, because physical is constrained by fabrication, logistics, and inventory. When paper falls but physical doesn't, it means the price you see is increasingly a leverage signal, not a clearing price for actual metal. Now here's the reveal I promised earlier, and this is where the story becomes systemic. There are reports and estimates suggesting there can be hundreds of paper claims for each ounce of deliverable silver in certain vault categories. Numbers like 356 to 1 get cited. I want to be careful here, because the exact ratio depends on definitions. Open interest, eligible versus registered inventory, deliverable classifications, and how you count claims. But the direction of the problem is real, even if you debate the exact figure. The paper market is many multiples larger than the physical float that can realistically be delivered on demand. And that's not inherently fraud. That's how futures markets work. Most contracts net out financially. The systemic risk emerges when too many participants want the same thing at the same time: delivery, or immediate physical access, or withdrawal from the paper system. Then the math stops being academic and starts being existential. Think of it like an airline. Airlines routinely oversell seats because statistically, not everyone shows up. Most days, it works. The day everyone shows up, you get chaos at the gate. In metals, the gate is deliverable inventory. And when the gate looks thin, panic gets nonlinear. Now, I'm going to make this even more uncomfortable, because some of you are already thinking it, and ignoring it doesn't make you safer. Was today manipulation? Here's my investigative answer. It's possible, it's plausible, and it's extremely difficult to prove in real time. What we can say is that the incentives are not clean. Large banks have historically been dominant players in precious metals derivatives. There have been past enforcement actions and fines in the broader metals space. There are also widely discussed reports about large institutions holding significant physical silver positions while simultaneously participating in derivatives markets. If you see a perfectly timed rule change right as price hits a major technical level, you're not crazy for raising an eyebrow. But I need you to understand something that matters more than outrage. Whether today was orchestrated or organic, the mechanism of damage is the same. Leverage got purged. Weak hands got forced out. Price discovery got temporarily dominated by margin mechanics instead of fundamentals. And if you build your strategy around moral judgments instead of market structure, the market will take your money and not feel guilty about it. So the question becomes, what now? This is where we stop staring at the 90-minute candle and start thinking like risk managers. There are two broad scenarios. Scenario 1. This was a topping event. The margin hike plus multi-decade resistance marks a cyclical peak, and silver enters a larger drawdown. Weeks, months, possibly longer. If that's the scenario, you will likely see physical premiums soften, not spike. You'll see inventory pressures ease. You'll see the market's obsession with shortages fade. And you'll see rallies get sold aggressively below that long-term resistance line because it has now proven itself as a ceiling. Scenario 2. This was a leveraged shakeout inside a secular bull market. In that scenario, what you just watched is not the end. It's the market removing tourists. It's the market resetting funding rates, reducing speculative positioning, and allowing the next move to be driven by more patient capital. In that scenario, physical premiums remain stubborn. Inventories remain tight. Industrial demand keeps pulling metal through supply chains, and price eventually challenges that resistance again, except next time, with less leverage to liquidate and more structural bid underneath. History gives you examples of both. After 1980, silver went into a long wilderness. After 2011, silver suffered a brutal bear market, but the larger monetary backdrop, debt expansion, currency debasement, geopolitical fragmentation, never actually resolved. It merely postponed the reckoning. That's why these markets keep coming back from the dead. And now we need to talk about the deeper backdrop, because focusing only on silver is like focusing on a single wave while ignoring the tide. The reason precious metals keep resurfacing is not superstition, it's sovereign arithmetic. Modern economies are built on credit expansion. The United States alone carries debt at a scale that cannot be paid back in the normal household sense. Governments refinance, they roll, they extend maturities, they rely on nominal growth, inflation, and financial repression to reduce the real burden over time. That process is not a conspiracy, it's a policy toolkit, and it tends to reward holders of scarce assets while punishing holders of cash that yields less than inflation. This is why gold exists as a monetary asset, not because it produces cash flow, but because it's a credibility anchor when credibility is scarce. And silver, because it straddles money and industry, becomes the wild card. In periods of monetary stress, it trades like a high beta version of gold. In periods of industrial expansion, it trades like a strategic material. In periods of both, which is where we may be heading, it becomes something much more dangerous to short. Now, I want to give you a practical framework, because you don't get paid for being right. You get paid for managing risk. If you're leveraged in silver, futures, options, high-margin CFDs, today was your warning label. The exchange can change collateral requirements, and you can be correct on direction and still get liquidated. Markets can stay irrational longer than you can stay solvent. That's not a quote for mugs. It's a survival rule. If you're unleveraged, physical metal, fully paid ETFs, low debt miners, your risk is different. You can sit through volatility, but you still need a plan, because drawdowns can be psychologically violent even when they're financially survivable. Here's what I'm watching next, and I want you to watch the same signals, because they cut through noise. First, the round number psychology zone around $100. Markets love round numbers because humans love round numbers. If silver stabilizes above that area and builds a base, it suggests today was a purge, not a collapse. If silver loses that area decisively and rallies fail beneath it, that shifts probabilities toward a deeper unwind. Second, physical premiums. If premiums collapse, it means real demand is fading and the physical market is loosening. If premiums remain elevated or rise, it means paper is doing its own drama while physical buyers quietly absorb supply. Third, exchange inventory and deliverable categories. Again, don't get hypnotized by a single data series, because accounting categories matter. But watch the trend. Persistent drawdowns in deliverable inventories while price remains volatile is not a nothing burger. It's stress. Fourth, policy signals from major producing and consuming blocs. Export restrictions, strategic stockpiling, industrial subsidies, these are not academic. They are geopolitical chess moves, and commodities are where that chessboard turns into real-world constraint. Fifth, the exchange itself. If there are further margin hikes, that can extend the forced selling phase. If margins stabilize, it gives the market a chance to find a cleaner clearing price. Now let's close the loop I opened earlier about that 30-year white line, because it's the part that should keep you disciplined. In 2008, silver tagged that long-term level and then ultimately delivered a 462% run into 2011. But it didn't do it smoothly. It had savage pullbacks, moves that convinced people the bull market was over, before continuing higher. That is how silver behaves when it's in a real macro-driven repricing. It rewards patience and punishes impatience in the same week. So when someone tells you, today proves the story is dead, ask them a simple question. Which story? the 90-minute story, or the 30-year story. Because the 30-year story is that silver is a pressure valve for two forces that don't resolve quickly: monetary credibility crises and industrial resource constraints. A margin hike can slow speculation. A margin hike cannot create new mines overnight. It cannot unbuild solar capacity. It cannot reverse electrification. It cannot make debt suddenly manageable without debasement or default. That's why margin hikes are speed bumps, not brick walls. They can be vicious speed bumps. They can break your suspension if you're over-leveraged, but they don't change the roadmap. And now I want to speak directly to three kinds of viewers, because this is where money is actually made or lost: during emotional turbulence. If you panicked and sold into the flush, I'm not going to moralize. You may have reduced risk appropriately, or you may have capitulated at the worst time. The difference is whether you had a plan before the candle turned red. If you didn't, take today as tuition. Markets exploit unplanned behavior. If you're thinking about buying the dip, understand what you're really doing. You're not buying a product. You're buying volatility. Scale matters. Timing matters. If you go all in because you want to catch the bottom, you're making a leverage decision emotionally, even if you're not using leverage. Scale in. Respect that silver can fall further even in a bull market. The market does not owe you a clean entry. If you're on the sidelines with no position, you actually have the best asset right now: optionality. You can wait for confirmation. You can watch whether the physical market stays tight. You can watch whether price reclaims key levels. You don't need to prove courage by acting fast. In macro, speed is often the enemy of accuracy. Now I'm going to end with the darkest, most honest takeaway from today, because it's the one you need to carry forward. That $1.7 trillion didn't evaporate. It moved. This is what markets do in moments of stress. They transfer wealth from the overconfident to the liquid, from the leveraged to the patient, from the emotional to the prepared. The screens call it a crash. The system calls it a reallocation. And if you want to survive and actually benefit in a decade defined by currency dilution, geopolitical fragmentation, and resource nationalism, you have to stop thinking like a spectator. You have to think like a risk manager inside a system that is not designed for your comfort. Silver just hit a 30-year ceiling and got rejected. That's real. The exchange tightened collateral rules and forced selling. That's real. Physical premiums held up while paper price collapsed. That's also real, and it's the part I would not ignore. So here's the question you should be asking now: not whether silver crashed. The question is whether this was the purge that clears the runway or the crack that signals a broader unwind. We don't get that answer from one day. We get it from what happens next. Whether $100 holds, whether physical tightness persists, whether inventories continue draining, whether the next rally gets sold or breaks the ceiling, and if silver eventually breaks above that multi-decade resistance level cleanly, if it turns the ceiling back into a floor, then today's 12% flush won't be remembered as the end. It will be remembered as the admission fee. Drop a comment with what you're watching: price levels, premiums, inventory data, or policy shifts. I read them, and I use them to triangulate what the crowd is missing. And if you know someone who panic sold or is about to revenge trade this market, send them this. Not to scare them, to sober them up, because the hidden economy doesn't reward hype. It rewards preparation.